traders, Todd Gordon here with TradingAnalysis.com. This is going to be a free video update for Saturday, October 3rd. I had to do a video. You guys are so much activity on YouTube, and you guys are giving me so much feedback on the recent calls we've been making. We've been, knock on wood, calling the market pretty well. So I just want to follow up, show you where we are, just give you some thoughts over the weekend and stuff like that. So the videos, you guys are tearing it up with the likes, which I appreciate. That helps me rise up to get the content out there. There's so much on YouTube. And then the comments, you guys are so funny. You guys are all over it. So appreciate it. So we had a nice call in this last video. The headline was a little, it was a little confusing because I said here the S&P is about to get barreled by the coming hurricane. And I start off, if you listen to the video, saying, okay, well, we're long the market, and we were long coming into non-farm payroll. Of course, 140 whatever thousand jobs come out, and I was like, oh God, here we go. And the market, just true to form, rallied higher. So, you know, where are we? And the market basically shrugged off all the bad news from non-farm payroll, and we're rallying really sharply. So a lot of you guys are like, okay, are you changing your outlook? And the answer is no. We came in long in the SPY. We had 188, 187 put spreads. We're long. We pieced out into the close Friday, and we're still looking to go short, guys. This is a classic setup. Okay, you have 5 waves down here in the S&P. You have a nice 3-wave move up. Okay, let's see, where's the retracement? 61% retracement is at 1962. That's a money level to be short. Inside of that, if you can get a 3-wave move up, the point at which A wave is equal to C wave, that's at 1949. That's your 100%. That's your measured move. That's awesome. And then if we squeeze through 49, we have the 1272 up at 1927, and then I did an external retracement of C versus B, so you have the 1618 and the 200%. You have two very, very clearly defined FRZs between 45, let's call it 1947 is number 1, and 1963 is number 2. This is a beautiful 5-wave move down, a sharp 3-wave move up with equality between A and C into the 618 retracement. That's a sell, guys. So as strong as that market was, you know, like I said, I still have a small long. I hope the market gaps up. On Monday, we can sell the rest of our longs, get short, and we're going to look to move down. Now, could I be wrong? Absolutely. You know, knock on wood, like you guys are pretty happy with the calls I've been making. This can't continue. It can't. I mean, we've called basically every turn in the market here. And as soon as you say that, the trading gods humble you. So, got to have your stop losses, and that's going to be 1988 if we're wrong on that trade, okay? So, with all that being said, guys, you know, we have some pretty significant things going on in this market. Don't get caught up into this bear market, okay? This is nothing more than a bear market rally. When you have such a sharp move like we saw, I think it was like 110 points of move in the S&P futures. I got to ask you, you know, don't get caught up, and I'm going to ask you, do you think this uptrend is broken in the market? On the S&P monthly, is the uptrend broken, or are we intact? If you look at this chart, which is your regular arithmetic scale, you would say, yeah, dude, we're above trendline support. It's all the way down to 1750. Absolutely. You're wrong. We have broken trendline support. If you go to log scale, reconnect your trend line from the credit crisis low to the European crisis low, the proper scale on your charts, which is widely available, is log scale. When you start looking at a move that went from 667 to almost 2200, you know, that's a 320, 350% move in the S&P. That's massive. It's probably 300% move, whatever it is. We've broken support. So don't get trapped in these bear market rallies, okay? You expect real sharp moves up. When you have a 3-wave move into resistance, that's a problem. So I think we have significantly lower to go. All right, now keep in mind, we are about to do a big class, okay? I've done 2 of these webinars over the last 2 weeks. The GoToWebinar room can only hold 1,000. The first time we had 2,500 people registered. Last time we had like 2,200 people registered, and they were packed. So if you weren't able to get in, we're gonna do this one more time. Like the response has been pretty awesome. So we are gonna do this death of the market? Is the liquidity bubble about to pop, and how to handle it? So we're going to do this webinar one more time, okay, just because the webinar room is unpacked. So if you want to get involved, it's going to be Tuesday night at 8 o'clock in New York, 5 p.m. Pacific. We're going to talk about the current situation in the market. I'm going to show you how far I think the market's going to go down. I'm going to show you the way I'm handling this with my longer-term capital. Market sectors and ETFs that I think are especially prone to falling and rallying in a risk aversion situation. Basically, why I think the Fed is pretty much screwed. And that's going to be my wife telling me to come up and help with the babies. Yep, I'll be right there, babe. And how spiking interest rates affect volatility. So this has been a really well-received webinar. So if you want to get involved, I'll flip you over to this page. And this was a really nice email that I got from a client. And it was really sweet. And I blocked it out. And she wrote, again, you killed it. I work with portfolio managers and hedge fund managers who are crying practically about the turn in the market, yet you've proven once again technical show us the way. Webinar is not educational but insightful. It can help so many fundamentalists out there. So it was really, really nice. So that's the webinar. So that's going to be Tuesday, 6 o'clock. I hope you guys want to get involved. I'll flip you over, sign up, and we'll see you there. Take care, guys.